Our next guest, though, I want to get to him. He says he's been bullish on the market ever since last March, and his basic view hasn't changed. He's Joe McAlinden. He's fund manager at Catalpa Capital. Good to have you here on Taking Stock, Joe. So let's go back to, we didn't hear the sound, but we did talk to Martin Feldstein earlier today. He's still concerned about an economic double dip. Do you think he's wrong completely based on what you're seeing in terms of the economic data?
Well, I don't think he's wrong to be concerned. There's always concern, but I think if we do get a second leg of a downturn forming like a W, right, instead of a V, it won't just happen. It'll be because of policy mishaps in Washington, frankly, or something extraordinary geopolitically.
Hold on for a second, because we do have that sound now from Martin Feldstein. I just want to run it for our listeners.
There remains a risk. I think the risk is lower than it was a month or so ago. We've had some good positive numbers, but I think the risk of the double dip remains.
All right, there you have it. But so he's still saying that. I mean, I guess when some people, Joe, look at either the housing market at this point, they look at the deficit that continues to grow, those are valid concerns.
Look, the deficit is a huge problem going forward, and how we deal with it is one of those policy questions, right? That will affect what the intermediate and longer term in the United States looks like. Right now, the deficit is looming out there. It's actually not directly hurting the economy that much. It actually is hurting it some, because when the government's in there borrowing $1 trillion a year, it means that that money is not being used for something else, right? However, they are spending a lot of that, and the people in Washington still believe in the Keynesian multiplier that I was taught in college, which has been proven not to work.
Right. It's interesting to watch.
And so we're kind of stuck in that. But I think that in the short run, what's been driving the stock market and what is driving the economy, and I believe will continue to drive it for the next 6 quarters, is the massive easing of monetary policy. And that's working. That's why stocks are up 70–75%. That's why most commodities are up. That's why we're seeing these booming retail sales and all these other numbers.
Financials making tons of money. I mean, there's easy money out there.
But that's the short run. And I think we've got another 3 to 6 months to go from that move, and another couple of quarters of north of 6% GDP growth. But then what happens next depends on both monetary and fiscal policy issues. If there's a massive tax increase, if there's a sudden and severe tightening of monetary policy, Feldstein's concerns could be validated.
How likely are either of those scenarios? I mean, I hear a lot of people talk about higher taxes. You've got to figure out some way, either reduce spending or you raise taxes.
Higher taxes are definitely coming. Let me just touch on the monetary policy. I think the monetary policy, a major tightening over the next 6 to 12 months, is highly unlikely, almost a remote possibility. So let's table that one for the moment. The expiration of the Bush tax cuts, they're going to let that happen. I think the whole economy knows that's coming and it's priced in. What would be a big negative if there was some kind of additional surcharge on corporate profits or high-income people. It's the kind of stuff they did in the 1930s, that some economists tell you fixed the Depression, others will tell you prolonged the Depression, and I'm in that latter camp.
All right, let me ask you about corporate earnings. We got the Alcoa numbers. They beat a little bit on the EPS number, although analysts had been bringing down their numbers. They missed on the revenue number. Just our first report. I mean, how key is the Alcoa number in your view? Well,
it's one number out of 30 for the Dow and out of 500 for the S&P. There's a lot more to come. There are a lot of company-specific moving parts in that P&L. I think we have to look to the other numbers as they come out over the next couple of weeks. My belief is that because of GDP being stronger than everyone thought, surging productivity, and firm commodity prices, in the aggregate, you're going to see huge upside earnings surprises.
You've been bullish for a long time, I think since last March. It was a great call. That's when we hit the market bottom. We're up about 80% on the S&P 500, had Dow 11,000 closing above it today. Let me ask you, when do you start to temper your enthusiasm? Again, does it go back to some of the policy changes and things coming out of Washington, or?
Yes, and valuation levels and sentiment. So just on the latter point, sentiment's gotten more bullish, but it's only beginning. Retail investors have just begun to get back into mutual funds. Your network was reporting on that earlier today. Sentiment is moving up, but it's nowhere near bull market peaks. On valuation, it depends on what you think earnings are going to be. But based on what I think earnings are going to be, the market still is cheap. I think the Dow next year could earn over $1,000 a share. and sell at 14 or 15 times earnings.
All right, we've got about a minute left here, Joe, so let me ask you, so where would you be putting your money at this point? Do you play the consumer side, as some say, because we're seeing consumer spending pick up?
Yeah, let me just mention one kind of offbeat one, when that is in commodities.
Right.
I like natural gas. Nobody else does.
I know, and natural gas has come way
I
down.
think natural gas is a double over the next 2 years, maybe more.
So play in terms of the various equity players within the group?
You can do it, you know, professional investors can do it through futures and other instruments. But back to equities, I like consumer discretionary. I think housing also is going to be a big upside surprise. Dr. Schiller had a big piece in the Times yesterday.
He's not so sure.
He's still cautious, but he hasn't always been right. He's got, you know, he's done wonderful research. No, we think actually there's going to be some big up surprises in housing. An actual shortage in the next 6 to 9 months.
Which I find interesting.
Which is going to drive consumer discretionary spending even higher.
So some of those, white box retailers and so on and so forth?
White box, carpets, home builders as well will benefit.
All right, we got to leave it on that note. Joe, thank you so much. We appreciate it. Joe McAlinden of Catalpa. We're going to take a break.